Hi, and welcome everyone to this little intro lecture for the HHL VCC Investment Cup. We're all very happy that you are going to join and very much looking forward to meeting all of you in Leipzig. My name is Sebastian Schreiter. I'm a junior professor here at HHL for the topic of entrepreneurial finance, and it's my big pleasure to guide you through the materials that we have also sent over for a little bit of preparation. No worries, they are not really a prerequisite, but we thought it's a nice idea if you have a little bit of content to study before you actually come here. Yeah, I will also try to keep that rather short and informative and more, let's say, commenting a little bit on the slides instead of really holding a full-fledged lecture. Yeah. So let me maybe share the slides that you have also received, and then we go through them in, I would say, a rather fast manner. Yeah. So this is the slide deck that you should have gotten. Some information about myself should come first. I actually skipped them here. That's good. And then let's go directly into the three different parts that we would like to bring across before you basically come here for the Investment Cup. So I want to give you a little bit of an introduction to venture capital. What is it? When is it really needed? So that is the stuff that we want to discuss here. Then a quick overview on what is the investment process. I will be very short on that because I believe that is something that you will also get to know from venture capital investors that will be present during the event. And then last but not least, I want to focus a little bit, let's say, on the technical stuff that might be helpful during the casework. So I'm going to talk a little bit about how financial planning and planning of innovative new business models or growth ventures basically works, how we transfer that then in understanding customer economics, and last but not least, what is a quick and easy idea of like figuring out what the value of a startup might be. Yeah, so that is the plan of attack, and then let's quickly get into that. Yeah, so introduction to venture capital. The first thing that we should agree together, or that we should scope, is basically what are the companies venture capital are really interested in. And those are the so-called startups. And the startup is not every newly founded company is a startup, but a startup in our venture capital perspective definition, so to speak, is a young new company that needs external financing. Why would it need external financing? Well, because it tries to come up with somehow innovative, not yet established business model. It may try to disrupt something, yeah, and then not just disrupt basically a market, but on top of that also tries to scale up that disruption. Yeah, so you first try to innovate, establish business models, disrupt them, and then basically you try to scale it up. And that may obviously need a lot of initial funding before you then basically make money out of that. Yeah, maybe for research and development, maybe for marketing, yeah, maybe for setting up infrastructure, all that kind of stuff could be reasons why we need, so to speak, external financing. Yeah, so let's keep that in mind. First of all, that is a little bit the scope, so to speak, of companies we are really interested in from a venture capital perspective. Yeah, and then we see here a very classic life cycle of startups. Yeah, obviously can pretty much deviate among startups, but this is more or less something that we see quite often. Yeah, so there is an idea or proof of concept phase where we will not make any kind of revenues, just burn money, but maybe not even burn money to the highest extent. But then comes the market entry and this idea of scaling up, and that might be a moment when we are already making revenues, but we are actually even burning more money because we first have to push the product into the market. Yeah, so you see here the two lines for profits and cash flows that would in this phase be very, very negative. Yeah. And then just later on in the growth phase, somewhere there might be hopefully the break even. Yeah, pretty often first in profits, later in cash flows, because we still keep investing. But to be honest, this can also be the other way around sometimes. Yeah. Okay. And then obviously in the very last phase here on the right, you see that there might be some kind of exit. Yeah. And that I believe is very important to know and to understand. Whenever venture capital investors are involved, there has to be almost certainly an exit. Yeah, an exit is then very much what is desired. Yeah, because venture capital investors are not really interested in staying in for forever and getting dividends or something like that, but they basically want to see a huge reimbursement, an exit proceed. Yeah, how could such an exit look like? I mean, could be a strategic sale or an M&A sale to a strategic investor, yeah, maybe bigger company, competitor, yeah, something like that. Or it could be an IPO, yeah, so that we basically bring the company public, yeah, that it goes to the stock market, yeah. And in rare cases, it could also be that a financial investor maybe directly takes over like a private equity fund, yeah. So those would be the different channels. And obviously, only a few of those young companies, startups or scale-ups really make it to that stage. Yeah, so usually we see default rates of like 50 to 60% over like really big global samples of companies that get liquidated along this way without having such a nice exit proceed that I described. Roughly 10 to 15%, just that you have a little bit of a feeling, may make it. Yeah, again, it's not industry specific, like the overall sample will make it into an IPO. And the others in between, they may have some kind of M&A, but also for the M&A, it might well be that you basically get less out of that M&A than what you have basically invested or what investors have invested over time into that startup. Yeah, so just that you have a little bit of a feeling. On the bottom of that slide, you see different types of investors that are investing in the different stages. Yeah, at the very beginning, we see bootstrapping and business angels, going to define that a little bit further in a moment. And then the VCs, the venture capital comes in. And usually we roughly say there is early stage, later stage. Yeah, we can make that even more detailed, but let's stick to that for the moment. Yeah. And now let's define those investors a little bit further. Yeah. I tried to do that on this slide here. At the very bottom, you see what bootstrapping means. This is basically if you're using your own funds or if you use the funds of family, friends, and as we sometimes say, fools. Yeah, so the 3 Fs, yeah, family, friends, and fools is what we say pretty often. Yeah, so that would be the bootstrapping part. Obviously, in terms of amount, by far the smallest, but maybe the most important one, because this is where you get the whole thing running first of all. Then usually we have business angels coming after that. Pretty often those are high net worth individuals, maybe people from big families, yeah, with family companies, or maybe people that have been quite successful themselves in founding a company and now they want to reinvest into the ecosystem. Yeah, and nowadays we also see that those individuals may team up in business angel networks, because obviously might be a quite good idea, instead of me investing into 10 different startups, if over a bigger network I'm able to invest into 100 startups. Yeah, why is anyways this difference? Well, this difference is pretty often there because you have to go in with a minimum required amount. Yeah, so I don't know, let me say 20,000 euro ticket or a 50,000 euros ticket or something like that. Yeah. So you cannot really split it into 2,000 or 5,000 euro tickets. No company, new young company would be really interested in that, because then you have a lot of shareholders right from the beginning. Everyone wants to tell you how to run your business. So you would rather look for a little bit bigger tickets. And that's the reason why it may make sense as a business angel to team up with others. Yeah. And venture capital is, so to speak, the institutionalization of that. Yeah. So where you're really coming up with a fund, where you are collecting money from so-called limited partners. I have another slide on that, how that looks like. And then basically this fund invests, usually with some kind of hypothesis. Yeah. So maybe there is a sweet spot in terms of phase. Yeah. So maybe you always invest in the prototyping phase or a little bit later or whatsoever. Yeah. Maybe there is a hypothesis or a sweet spot regarding the industry or the region you're investing in, something like that. Yeah. And this venture capital, so to speak, is volume-wise or money-wise definitely the most important part. This is what really helps you to scale up. Yeah. And on the right-hand side, you see two special cases of venture capital: corporate venture capital and public venture capital. Corporate venture capital is basically when big corporations set up their own funds to basically drive startups and innovation. Yeah, pretty often with the idea that they say, hey, we are ourselves too slow. Yeah, our processes are too complicated. Let's rather take some of our money and invest that into young, innovative ideas that are running outside of our huge corporate ship, so to speak, and gets developed there. And then later on, we can think about whether we acquire that company. And if we are already an investor in that company, so to speak, that might be cheaper, or being an investor in that company also helps to see and check and control a little bit what kind of key technology is developed there. Yeah, so just that you have a little bit of an idea what could be out there. Some CVCs are also out there really like pure financial investors. They are not really investing close to their core business. That could also be the case. Yeah, so those different routes are out there, but pretty often the idea is to drive innovation. Yeah, and then there is public venture capital, in particular in Germany. It has been very, very important in the 90s, early 2000s, when the private venture capital, so to speak, hasn't been out there. Yeah, so Germany is pretty much a banking market. People are quite risk averse. So venture capital needed a little bit. Yeah, so when in the US it was already quite common to invest into startups and to sometimes fail and to sometimes have skyrocketing returns. That was a totally awkward concept in Germany. And public venture capital was out there to basically help young, innovative ideas at a time when the private venture capital was not there. Public venture capital still exists, is in particular important when we look into high tech or deep tech things. Why? Because in the moment where development cycles are very, very long, private venture capital might be a bit hesitant. Yeah, because usually they have a lifespan or an investment horizon of like 10 years. And if things are longer, then they may shy away from that. And this is where public venture capital can basically help. And obviously, when we look into social startups, this is also where public venture capital can help. On the next slide, I've just collected some logos, some examples, just that you have a little bit of a feeling who is out there. Yeah? Maybe just because I was talking about public venture capital, the high-tech Gründerfonds in Germany is actually a great example of a public venture capital fund that has been even return-wise very, very successful and really helped a lot to foster the ecosystem. Yeah, and then venture capital firms, I mean, you may have heard about some of those that are out here. To be honest, I now rather chose internationally renowned ones. Obviously, there are also some that are very important players in a specific industry or in a specific region. Yeah, HHL has a lot of those in their network, yeah, where basically alumni have been co-founders and have developed those funds very much. Point 9 would be a nice example, yeah, for a fund that is very much into software as a service investments, and they are very much, let's say, early stage seed and Series A, yeah, and they have been super successful. So this would, for example, be an example of maybe a little bit smaller but very successful fund. Yeah. Okay. So just that you have a little bit of an overview on that stuff, and now let's deep dive a little bit into how a classic venture capital fund or private venture capital fund works. Yeah. So you usually have you have a venture capital firm. Those are usually quite small entities. Yeah, a few partners running that firm. Maybe they have some analysts, some people in there, but very slim. And these firms, they are issuing funds. Yeah, and such a fund, as I already said, usually has some kind of investment hypothesis. I mentioned already how that should look like. And it is a limited partnership with a finite lifetime. Yeah, so it is usually 10 years, and those 10 years can be extended to 12 years if you are still waiting for some good exits. Yeah. And then in this fund, you are basically inviting other investors to input their money. Yeah. And we call those ones limited partners. Who are those limited partners? Usually pension funds, insurance companies, maybe family offices, maybe some very high net worth individuals. Yeah? So they would invest their money, and then the partners of the VC firm, they would basically take over the management of that fund. We call those ones the general partners. Yeah? So the general partners, they come from the VC firm, and they are managing the fund. And the limited partners, they are outside the VC firm, and they are providing most of the capital, so to speak. Yeah. And then the whole fund process starts. Once the money has been committed by the limited partners, then basically the general partners can start managing the fund, screening for so-called portfolio companies. So startups they want to invest in, and then they hopefully step by step strike deals, and hopefully then those startups invest in a quite promising way, and then we see some good exits. Yeah, and once these exit proceeds are flowing back, then we can basically repay the limited partners. Yeah, so that is the quick idea of how that works. What else is important? Well, VCs, as you have already seen from how I have defined and described this, they are basically financial intermediaries into the private company market. Yeah, so investing into startups really from the outside, yeah, so being some kind of pension fund is quite difficult. Yeah, because I mean, you would need to do a lot of screening, a lot of negotiation to basically really just get in maybe one single company. Yeah, it doesn't make sense. Yeah, so the VC really works as an intermediary towards this private company market, and the VC usually takes a quite active role. Yeah, so the general partners in the VC fund, those are usually experts in some way. Yeah, so either they are previous founders, or maybe they have a great network into a certain industry, yeah, towards experts, towards potential customers, whatsoever. Yeah, so hopefully they bring some kind of USP where they can, so to speak, then help the portfolio company. Yeah, and then I already mentioned that the idea of a VC is basically to exit at some point in time and to maximize the financial return. Yeah, so it's not about staying in there forever, but like really going in and then maybe with a time span of, let me say, because this has, depending on whether you invest rather early or rather late, has a little bit of a span. Let's say they go in with an investment horizon of 3 to 7 or 3 to 9 years. Yeah, as I said, depending on whether you are rather investing early or a little bit later. Yeah. Okay, so this is maybe main characteristics about VCs. And then here on this slide, this is maybe already a little bit too much nitty-gritty, so I will go through that rather quick. But here you see a little bit how the lifetime of such a fund may look like. Yeah, so in the first years, there are the investments in the portfolio companies, and later on, the exit proceeds may occur. And the cash flow structure is as follows. The general partners, they get management fees each and every year, independent of the performance, and they may get some carry or carried interest when they really strike good exit proceeds. Always then when the money that has been contributed by the limited partners is somehow exceeded. Yeah, so if they have been paid back in full, then basically some kind of carry goes to the general partners. Yeah, there is more detail on that on this slide. Yeah, where you, I believe, understand that a little bit better. So management fees, as I said, is what the general partners get, totally independent of performance, and then the carried interest is basically what they may get if they have been quite successful. Yeah, so if the exit proceeds are so high that limited partners have been fully reimbursed, then pretty often we see a split of like 80-20. Yeah, so from all the exit proceeds that overshoot, so to speak, this initial investment of the limited partners, this is then split 80-20, 80% to the limited partners, 20% to the general partners. We call it also a kicker. Yeah, so that is, so to speak, the incentive of the general partners to keep going and to invest their time and resources and their expertise, because this is what they really want to have and what they are really interested in. Yeah. Okay. So I would say this concludes chapter number 1. Then let's go into chapter number 2. And as I said here, I really want to be quick for 2 reasons. A, because I believe the slides are quite self-explanatory. B, because I think it's way more authentic to get this whole investment process explained by someone who is a venture capital investor, him or herself. Yeah, and you will definitely get the opportunity during the event. Okay, nonetheless, this is usually how it looks like. So you screen for a lot of different ventures and ideas. You may receive a lot of pitch decks. And then in the end, you will really just, on a very tiny number out of that, you will basically close. Yeah, so here in my example, out of the 1,000 that go into the funnel, you would basically just close 1 deal. Yeah. And in the screening phase, it's obviously super important to somehow create a deal flow that maybe some others do not have. And then every VC has some kind of different types of questions they ask themselves. Usually they try to understand the market and the market potential. And then obviously they also want to understand whether the founders can really execute on that. Yeah? So usually those are the 2 categories. Yeah. Okay. And then what comes afterwards is like really nitty-gritty due diligence. Yeah, so a lot of stuff that you really check in very much detail and where you do your analysis. Yeah, obviously, the earlier the idea, the lower the amount that you first need to invest to get the thing going, the less detailed you do that analysis. I think that's quite clear. Yeah, so there are even some very, very early stage investors that would, I love that term, would say, hey, I invest a discovery ticket. Yeah, so to speak, I'm not doing too much of a due diligence. Let's give these guys 50,000, like the idea, and it's not really worth the effort of like really diving deep into that. But if we are talking about a little bit later rounds where really millions are invested, then definitely the stuff that you see here is stuff that gets checked. Yeah, somewhere in the middle is basically when we discuss for the first time a term sheet. Yeah, so the VC may send a term sheet to the startup and say, hey, those would be the terms. Would you be interested? And then negotiation starts. And the terms is obviously about, okay, usually the startup has asked for a certain amount that they need for the next growth phase. And then the VC may say, well, we are ready to invest this amount of money, but we want to have this amount of shares. Yeah. And this is basically, by the way, where valuation comes into play. Yeah. So you need a valuation to make that connection. Yeah. So how many shares do I get for the money that I contribute or that I induce? Yeah. And then beyond that, but this is a little bit, let's say, also beyond this little teaser lecture here. Beyond that, there might be a lot of quite technical and super, super important terms. Liquidation preferences, conversion rights, anti-dilution provisions. I just dropped the names. I'm not going into detail, but there is a lot of things to take care of in a real term sheet, because it's really important for the value of the shares that you get as an investor, for the value of the shares that you keep as a founder. Yeah. And it is also quite important for incentive setting. Yeah. But I'm not going into detail on that. Maybe we have the chance over the investment cup to chat a little bit about that. There is a lot to know and a lot to understand here, but I think that would go a little bit too much and is probably also not needed in the case you are working on. Yeah. Okay. So this, as I said, just quickly about the process. You will get, I believe, more juicy information on that during the event itself. And now I would rather like to focus a little bit on the technical part. Yeah. Let me start with financial planning and customer economics. I've put together some slides where I also believe they may help a little bit also for documentation purposes, where you can basically review and recap and come back. So I want to be rather quick. So financial business plan, first of all, is a great tool to check a little bit whether there is at all a roadmap that a startup can become viable or sustainably survive. Yeah? So I can basically see in such a business plan what needs to happen to make that whole thing work. Yeah. So my favorite example, take something like Gorillas or Flink. If you build a business plan for that, you will see that as long as the average basket size is around 20 or 25 euros, it's a horrible business model. It's just burning money. It's a catastrophe. Yeah. But if you achieve average baskets of like 40, 45, 50, maybe even 60 euros. Yeah? So if I change customer behavior towards people are doing their regular grocery shopping with these companies, then out of a sudden, this becomes a great startup, a great business model. Yeah. And the financial planning can obviously help me to understand that, yeah, so that I know what is really critical to focus on. For those companies, for example, it would have been much, much smarter to focus quite early on changing behavior of customers and increasing average basket sizes instead of burning a lot of money on more and more customers, because more and more customers with small baskets actually just mean that you even burn more money. Yeah. So maybe just as a little bit of an example. Yeah, so that is one thing to look at. And to understand this break even on a customer basis, I was talking about average basket size, this is what we call customer economics. Yeah, I'll have a little example on that in a moment. Yeah. Then such a business plan is pretty much a must-have in a financing round or when you want to do a funding event. Yeah. You need to ask for a certain amount of money to, let's say, survive the next 12 or 18 months. Yeah. So it's obviously quite embarrassing to ask for a certain amount of money and then 3 months later you say, I didn't ask for enough. Yeah, I actually need more. Not really a good thing. No one wants to have that. Investors want to see why you need this amount of money. So obviously you need some kind of financial planning. Yeah. And last but not least, and to be honest, this is quite entangled, I would say, with point number one here. It is obviously super helpful for management decisions, yeah, and for reporting purposes. So obviously, if I really have a good detailed business plan, set up, then I can really understand what are my priorities. Yeah, think about this example of the average basket size. Okay, cool. So those are maybe the 3 points for, let's say, what are the objectives or what's the purpose. And now you see here a little bit the steps. Yeah. So the first step is really that you should develop an integrated model where profits and cash flows interact with each other. Pretty often we see in startups, first of all, very much a profit focus, not in the sense that they want to be profitable, but that they really think about how does the profit and loss statement look like. Yeah. But the profit and loss, most of the times a loss, is not equivalent to what is the cash burn. Yeah? The cash burn is something else. Yeah? This really depends on the cash flow, and I need to plan out both or all the components, all the drivers to really figure out both of those things. And what those are, you basically see that here in the list. I'm not reading them out, but we basically start from the classic profit and loss line items, revenues, costs, and so on. I'm not reading them out. And then we go into investment activities. We think about working capital. We think about financing activities. So what kind of money is maybe induced over time? And then maybe as a very last, more sophisticated step, maybe about tax requirements. Yeah. So are there, for example, tax loss carry forwards that we can use? Yeah. And then once that is set up, and that's, let's say, the most important thing, that this model first of all works, then we can obviously come up with scenarios. Yeah. What happens if we can only make half of the growth, or if the growth is delayed? Yeah. What does that mean for my liquidity, for my cash burn? Yeah. What happens if regulation changes? Stuff like this. Yeah. Once the model is set up, we can obviously do this. We can obviously also do sanity checks. Yeah. Pretty classically. Yeah. So to understand how much of the market are we capturing? Is that really possible? And so on and so forth. Yeah. And then maybe more as a note, not so much as a new point. Obviously, such a business planning can be super, super detailed, and you can really lose yourself and lose a lot of resources in that. That's not the idea. The idea is just to go as deep as it is still helpful for you to understand the overall business development, but staying, so to speak, as general as possible to simply not burn too much time in that. Yeah. Okay. And then here you see a very classic basic structure for profit and loss statement on the left-hand side, and for cash flow statement, which reflects liquidity, on the right-hand side, and also how they are linked. Yeah. So the net profit is, so to speak, the starting point for the liquidity. And then I add back depreciation and amortization because this is just happening on paper. It's not really cash outflow. I need to account for changes in net working capital. Maybe that you have just one juicy example for that. Let's say while you are growing the company like crazy, let's say you are producing something, you may also need to increase your inventory, for example. But if I increase my inventory, that basically means that more cash is bound in the warehouse, and this inventory is part of the net working capital. So when the net working capital goes up, yeah, because the inventory goes up, then basically the cash flow goes down, yeah, because more cash, as I said, is bound in the warehouse. Yeah. Capital expenditures. This is obviously also a cash outflow. Yeah. So investments either in research and development, but maybe also in fixed assets. That is something that you won't find here in the profit and loss statement, but it is obviously important because it is a cash outflow and needs to be reflected here. Yeah, sale of assets would be the other way around, not really happening too often in startups. And then we have the financing part, yeah, equity infusions and changes in debt. Yeah, so just that you have a little bit of an overview. And on the next slides, I try to detail a little bit the different most important positions. Yeah, so first of all, revenues here, how to make some kind of estimate here. Yeah, I think it's important that usually we split into volume and we split into price. And either we can come top down, let's say from a market perspective. Yeah, this would be this. We think about what is really an available market for us, what is addressable, and then what is obtainable. Yeah, and obtainable is, so to speak, really what is our current goal of what we can achieve. And the addressable market is, so to speak, what is my potential? What do I think where I could end up at some point in time? I would be rather top down, and then bottom up would really be what would really go through that funnel logic that probably a lot of you have already seen. Here it is about conversions from awareness to familiarity to consideration, intent, and purchase. And then the question is, how do I make then revenues? Yeah, so what are my pricing strategies? And I'm not reading them out. You see that here. I think most of the words are pretty much self-explanatory. Yeah. And then here's a little bit of a summary slide on the costs. I wouldn't do it too complicated for a startup in particular, not for young startups. I would think about what are the costs that I really need to produce my goods or my services. Yeah, so costs of goods sold. Second, very, very important part is what do I have to invest to acquire a customer? Yeah, so those marketing and selling expenses, or as we would say in startup terms, our customer acquisition cost. Yeah, so what does it cost me to acquire a customer? So that is nothing that we should plan, let's say, in percentage of revenues or something like that, but like really we should plan out a customer base and should say, okay, now a new customer gets added. What is the cost to add such a customer? And that you have a little bit of a feel what it costs over different industries. I just put a little bit of a statistic here, but that is something that you would definitely ask a startup whether they know how much it costs them to acquire a customer. And then obviously some other metrics are also important, which is how long on average does a customer stay before the customer leaves again? What is the so-called churn rate? Yeah. Okay. So this is super important. And then there's obviously other stuff. Yeah. Everything that is usually rather fixed or jump fixed, as we would say. Yeah. Okay. And on the next slides, I then have details on capital expenditures and depreciations. Yeah. So we are now jumping to the cash flow side. So those slides explain once again, and also with a little example, why we should basically add back depreciations to the cash flow and why we should deduct capital expenditures. I think that is quite easy. And then I also already talked about net working capital. Also here, you have some more detailed information to look into if you want to have more understanding of that. Yeah. So what is part of this net working capital, and also here with a little bit of an example, how does that affect the cash position? Yeah. Okay. So now once I have done all that, what is the outcome of that? And I believe those are kind of the most important things. Yeah. Let me maybe start from the back. Yeah. So number 3, that you really understand your profit and liquidity development. So exactly those curves. That is obviously quite important. The other super important thing is what you see here on the left-hand side, the customer economics. I want to understand what is the customer lifetime value. Yeah. Why is that important to me? Because if I'm operating in a setting where every customer is actually kind of negative, then growing the business basically means to burn even more and more cash and to never have that perspective of really turning things positive and to get into the break even. So therefore, I'm really interested in those customer economics and that those customer economics are positive at some point. Yeah, because only if they are positive, I have the chance that at some point I may basically jump into the profit zone. Yeah. Okay. And then number 2 is obviously we can check for some key performance indicators, not going into detail on that. Instead, I would like to quickly discuss a little example on customer economics, customer lifetime value, because I could imagine that this is something that might be helpful also during the investment cup. Yeah. So I created a little Mickey Mouse example, so to speak, on a software as a service business. Let's say it's a B2B HR software. They have one paid plan, yeah, which has a subscription fee of 399 euros per month. There is a certain cost of goods sold. You see that here. They have an idea about their average customer acquisition cost. They know the churn rate. So a churn rate of 18% would basically mean that each and every year, 18% of their customers would cancel the subscription. Yeah. So just that you have a little bit of a feel. And they expect that, let's say, once they have more or less scaled up to a certain level, that the fixed cost that needs to be covered out of the revenues is 35%. This is probably the weakest assumption in that little set here. Yeah. Okay. And now how does such a CLV calculation look like? Well, first of all, I think about what is the expected customer lifetime. This is basically just 1 divided by the churn rate. And if the churn rate is per annum, then I have an average lifetime in years. Yeah. So roughly 5.5 years. Revenues per annum are 4,788. Yeah. So just the 399 times 12. Same for the cost of goods sold. The surcharge for the fixed cost, obviously just the 35% on the revenues. Yeah. And then let's say if we really simplify it and if we're saying, okay, future profits or future cash flows do not need to be discounted, then we simply multiply this the sum of those three with 5.56. So then we know what is the inflow from that one customer over the lifetime that we have with that customer. Yeah. If you want to discount it because you're saying some of the inflows come later, yeah, then obviously you would plan that out in different years and you would then discount it. But here, let's keep it simple. No discounting. We just multiply and then we deduct the customer acquisition costs. They just come once for this customer. By the way, also this might be a simplification. In many businesses, you have reoccurring customer acquisition costs there because maybe you give some discounts, some incentives so that subscriptions are extended and so on and so forth. Yeah, but just that you have a little bit of an idea how such a calculation could look like. And then, last but not least, let us very quickly and very briefly talk about valuation of a startup. A super frustrating thing to do, but a very, very important one. Why is that? Because in each and every financing round that you do, you have to put a price tag on your startup. And on average, you see that down here, every 1 to 1.5 years, you basically, when you're scaling up a business, you will have a financing round and you need to have this value, so to speak. And those values, they might be fluctuating a lot from round to round, and therefore it is quite important. Yeah. Okay. And now, why did I say it's frustrating? Well, because there are certain specifics of startups. Yeah. So obviously there is a super high uncertainty, which means I said that already 50% of those startups will fully get bust, and then some of them will really become so-called zombies or have quite low exit proceeds. Yeah. So super high uncertainty. That's super hard to factor in. The other thing is, most of the times the ideas are quite specific. There is a certain degree of disruptiveness, which means things are also hard to compare with other companies. That always makes valuation difficult. And then there are also some other factors, like maybe sometimes you may even accept a too high valuation to bring a company into the so-called unicorn club. A unicorn is a startup with a valuation greater than 1 billion. And this might be helpful because this comes with publicity, with access to more international venture capital investors and so on and so forth. So therefore, maybe sometimes it's not fully rational. You make your valuation, you come out with 900 million, and then investors said, hey, you know what? I'm overpaying. Let's say the valuation is 1 billion because then you guys are a unicorn. Yeah, simply speaking. Stuff like that could also be out there. The other thing is that sometimes it might be about competitive effects. Yeah, so it's really a high ridiculous price is simply paid to make sure that someone else is not getting into my type of business. Yeah. Facebook, Google, and WhatsApp is a very nice example. Yeah. So Facebook paid at that time kind of a ridiculously high price for WhatsApp simply because Google was also interested and would have loved to step into the social media business. Yeah. So just that you have a little bit of a feeling what could be out there. Okay. So what are different methods out there? Very classically, if you have a little bit of an idea about finance and valuation, then you may have heard about multiple valuation and discounted cash flow methods or discounted cash flow valuation. I do not want to go into that here. Sometimes that is helpful for startups, later stage startups in particular. You can already do a DCF valuation. Multiple valuation you can always try to do. It's always a bit fishy, but it's also an approach to take. But I want to focus on the very last one here, the VC method, the venture capital method. Yeah. So now how does that look like? Yeah, just simply in 4 slides. The idea is basically to kick the can down the road. Yeah. So the idea is we forecast the future results. Let's say the EBITDA, you may now wonder, okay, how does that work? But the idea would really be to say, or to come most of the times top down. Yeah, saying, okay, what is really the market that I'm serving? How big is that market, or how big might that market be looking forward? How much of that market can I capture? And with what kind of operating model, meaning what kind of EBITDA margin is realistic in such a business? Yeah, EBITDA margin is, so to speak, the operating margin. Yeah, EBITDA, earnings before interest, taxes, depreciation, amortization. Yeah, and then because this is already, let's say, at capital T, this is, so to speak, when I think there should be the exits. And it's not important whether we talk about 4 years, 5 years, 6 years, 7 years. Yeah. But usually as a founder, as an early stage investor, you have a feeling of like, what is the lifetime of that? Yeah. If that is, as I said, rather a high tech, deep tech thing, then it's longer. If it is an e-commerce business, it's maybe just 3 to 4 years. Yeah. So just that you have a little bit of a feel. Yeah. And then the thing is, out of the sudden, things become more comparable than they are right at the moment, because looking at the company when it's ready for exit, so to speak, let's say ready for an IPO, yeah, for going public to the stock market, that is something where I find comparables. Yeah, then I can say, hey, who has a somehow comparable business model, maybe also subscription fee business or whatsoever, and what kind of multiples have they been able to execute on? And then I can put such a multiple on my prediction, yeah, in a so-called EBITDA multiple, yeah. And then I have basically a potential value of the company at time capital T. So let's say in 5 years or 7 years from now. And now the thing is just that I need to figure out, if this is the future value, what is today's value? And here the idea is basically that we need to discount that back, yeah, with kind of the expected return of venture capital. This is empirically something around 15%. Venture capital investors will usually tell you 20 to 25%, but empirically they rather execute at or perform at 15%. So that's the one thing. The other thing to take into account is that only 50% of the companies roughly make it, depending a little bit on the industry. Yeah, so you might take a specific ratio here, but let's for me now say it's 50%. Yeah, and the other thing is whether you might get diluted through further funding rounds. Yeah, this would be this retention here B. Yeah, so empirically, from a really first round VC investment to exit, you get diluted by 50%. If you invest later, then you may still have 70% of your shares. Yeah, so just that you have a little bit of a feeling. And then I can take that into account and figure out what is today's value, the V0 here. And the very last step is super simple, because if someone asks me, so if the startup asks me for a certain investment, and I have an idea about what is today's value of the company, I can now basically ask for a share alpha, so that alpha times V0, times the value of the company, is actually this one here, my equity stake in that company. And this should ideally be higher than my initial investment, or at least at the same level. Yeah. So that is how the venture capital method can be applied. Yeah. I think it's more or less well described on those slides. And at the very, very final slide of that session, you see a little, I hope, juicy example. Yeah. So here we have an estimated exit after 10 years. The market size is 7.5 billion euros. We believe that we can capture 20% of that market at an EBITDA margin of 20%, and an EBITDA exit multiple could be 7. Yeah, so that means this future value could be 2.1 billion. And then you see here, we believe that 50% is dilution. The expected return per annum for venture capital investors, so our discount rate, is 15%, and the likelihood of success is also 50%. That basically means that discounting back those 2.1 billion brings us to roughly 260 million of today's value. Yeah. And if we get now offered 15% in that company, that basically means 15% of the roughly 260 million. This is the roughly 39 million down here. And if we have to put 30 million on the table for this, then we would, at least from a financial perspective, say, hey, okay, this is a deal that first of all makes sense. Yeah, so we get a little bit more than what we have to invest. Yeah, doesn't answer all the strategic questions, of course, but that's the financial perspective. And obviously, all the strategic part goes into that estimate. Is the market really that big? Are we really able in that competitive situation to get 20%? Can we really come up with an operating model where 20% of EBITDA margin is possible? And so on and so forth. Yeah. And this is also where the two perspectives, finance and strategy, come together in a very nice way. Okay, very good. That was my quick summary of the slides. I hope you have been able to take something out of that. And yeah, I wish you a great time until coming to Leipzig. And then, as I said, very much looking forward to meeting you there. And I'm pretty sure that you will have a very good time here at HHL. Okay, see you. Bye-bye.